Welcome to FreightWaves Today. I'm Craig Fuller here with Julie Vandekamp. We are looking at a strong Tuesday as we head towards Labor Day. We're just 10 days out, Julie, to really, when you think about the fact that 10 days since the holiday, because I always think of next Friday being the holiday. Any thoughts on really the market right now?
Yeah, I mean, I think we're seeing a lot more of the same. I've been watching, I was wondering with this being brake check week started this week, if that would create some disruptions. We're not seeing really a change in tender rejections, but we are seeing the daily spot rate numbers go up in the last 2 days.
Do you think that's like the last sort of like summer hurrah? Do drivers take off work this time of year to sort of like enjoy the Labor Day holiday? Like you just think it's freight demand?
I mean, I think some drivers might be avoiding the brake check, right?
Road check 2.0.
And taking off. I also think.
Is this the first year that we've seen this kind of? I mean, there's brake check week, there's road check week, but is this unusual to have two periods in a year?
I don't think so. I think and I think brake check week is always less of an event than the full road check week as far as drivers staying off the roads to avoid those inspections. But I also think, and we'll hear from Daimler today about remarketing, but I also think trucks are getting more and more maintenance issues as people have been holding on to them longer. So maybe this year is different in that regard. I'm not sure.
Yeah, it's an interesting sort of thought, is that the holding on to equipment longer means your maintenance cost. Anyone who's been around it, also insurance goes up, because as you have maintenance problems, as the equipment gets older, it is more prone to accidents. And really the number one predictor of accidents is tires and brakes. And so that's the highest correlation to accidents. And we've talked about driver issues being obviously a source of it, but really when it comes down to it, maintenance is the number one contributor. If you look at the NTSB data, now a lot of times we don't know everything that went on with the driver inside the cab. So some of it could be very other issues, but oftentimes the actual listed contributor happens to be related to maintenance.
I would posit that those maintenance issues, tire issues, for example. Now, some you just have a blowout, right? You don't know. But if drivers are doing accurate inspections and walkarounds when they start their day because they're doing everything the right way, compliantly, if they're pre-trip, would have caught a lot of that. So to me, a lot of those maintenance issues still go back to the driver.
That's a great point. I mean, look, and I've talked about this before, as a pilot, I'm responsible for inspecting my airplane every single time I get up in the air. And only a very small portion of accidents are caused not by the actual pilot. Like something like only 12% of the pilot is not responsible. Something freak happens with the engine or something. But you're right. Like pre-tip inspections are incredibly important. And when you don't, if you do a proper pre-tip inspection, you will catch the tire issues that you talk about.
Right. And
brake lights are
this
also,
might not be true, but I swear I read it somewhere that like most people who get, many times when people who get like DUIs, like not just commercial drivers, anyone, a lot of that is not necessarily always because of erratic driving. It's because there's some other maintenance issue that they haven't taken care of based on not being so aware of their surroundings. They have a brake light out. They have something else, and that's ultimately how they get.
Talking to, years ago, talking to police officers when it comes to DWI, the reason they pull you over is often another reason, as you point out. Like they need to, when the police are looking at cars that are passing them, they're looking for reasons to pull you over. That is something other than.
So it's not always erratic driving. It's that there's some other maintenance issue with your car.
Something's happening. Obviously, something's erratic.
Yeah, I would posit the same thing with drivers, right? That with commercial drivers, that the more compliant they are, the better quality of driver they are. That goes hand in hand with the maintenance of their vehicle.
Let's get into the headlines today.
We kick things off with a revealing look at how the strengthening freight market is flowing straight through to trucking credit conditions. BMO, the former Bank of Montreal and one of the largest lenders to the trucking industry, released its quarterly earnings, Tuesday showing dramatic improvements across every key distress metric. Provisions for credit losses plummeted to just $15 million from $41 million in the second quarter, marking the lowest level since the first quarter of 2023. Even more striking, gross impaired loans crashed to $440 million from $576 million one quarter earlier. a clear sign that the recovering freight market is lifting BMO's transportation business, which is believed to be about 90% lending to trucking. This may be one of the last glimpses into these conditions, as BMO announced plans in May to sell its transportation unit to private equity firm Stonepeak, with the deal expected to close before the end of the year. Meanwhile, cross-border supply chains are bracing for major disruption after U.S.-Canada trade negotiations collapsed spectacularly, just hours before a critical deadline. The United States imposed massive 50% tariffs on billions of dollars of Canadian goods, beginning at 12:01 a.m. Eastern Time Saturday, after negotiators failed to reach an agreement Friday. The affected imports include products ranging from cement and dairy products to hockey sticks and other goods. Canada is the second largest trading partner of the United States, behind Mexico, with cross-border freight between the two countries totaling $67.9 billion in June alone, according to the Bureau of Transportation Statistics. Canada has announced plans to retaliate against U.S. imports beginning September 8th, setting up the prospect of another escalating round of tariffs between two of the world's most integrated trading partners. One major sticking point with direct freight industry implications involved tariffs on medium and heavy-duty vehicles, with Canada wanting those vehicles included in tariff relief while Washington resisted. Finally, a major software consolidation play is shaking up the freight broker technology landscape. Descartes Systems Group announced Monday that it has acquired Tabi, a transportation management system provider for freight brokers, for $100 million in an all-cash deal. California-based Tabi's AI-powered platform oversees the entire shipment lifecycle, including quoting, sourcing, execution, and invoicing, and primarily executes truckload, less than truckload, in cross-border shipments. The Canadian company continues its aggressive acquisition strategy, having now executed 34 deals since 2017. Descartes CEO Ed Ryan stated that by combining their solutions, the company sees a significant opportunity to help freight brokers navigate change, streamline freight execution, improve operating margins, strengthen customer and carrier relationships, and support digital transformation.
So, Julie, a big transaction. Descartes has been very active in the market, buying a TMS. Any thoughts on this?
Yeah, I mean, I think it's certainly interesting, right? It was a $100 million transaction. I do see how it fits together, that it'll help brokers streamline execution, improve margins, support digital transformation is what they're talking about, so they can fold in Tabi's transaction, carrier, shipment execution into their global logistics network. Makes a ton of sense. I kind of think it speaks to larger consolidation in freight tech, though, as a whole, and that TMS and compliance visibility and all of that execution being all in one place is ultimately what people want. So I'll be interested to see where that goes. I was talking to our chief product and technology officer this morning about it. We were just bantering because it was interesting about how we kind of think this is where it's going. The TMS providers need to be significantly more agile and more customized, and that all of the partners that they work with, which is what's providing so much of the value for the end user, it's so rigid in how you can integrate and what you can choose to show. You know, we think about that with Sonar, like, are they showing the data that we actually want in there, and how are they showing it? And I'm sure that compliance and fraud mitigation tools feel the same way. So getting to a point where TMS is much more agile and highly customized for the user is ultimately where I think we have to go as an industry and what people want.
Well, it's interesting because I think we've seen the large platform companies. I mean, Descartes has been very active. Their business model is essentially rolling up these disparate technology services that serve the freight business. But it is interesting because I think it's just a continuation, as you've mentioned before, is that these are large-scale platform businesses that are looking for add-on functionality, distribution, serving their customers deeper. And Descartes, years ago bought MacroPoint. Now they're buying a TMS. And so I think this is just the idea is that we're seeing a lot of transactions. The AT has been very active in the M&A market. Triumph has been very active. OTR has been active. I think we're going to continue to see more and more consolidation of the freight tech space. And when you think about the fact that freight tech, really the born-on date for venture capital investing in freight was 2015, sort of like the first sort of tranche of companies. We're now 11 years into that period. It makes sense that we would see a lot more transactions as these companies that have some scale, but not massively big to be their own acquirers. I think we're going to continue to see more and more of this.
I do too. I think we'll talk a lot more about the BMO headlines with John Kingston later in the show today. And we talked a little bit about the Canadian tariffs yesterday. And then, obviously today they've said, or since then I've read they've said that there will be retaliation.
Yeah, well, they said
in
that
September.
That's what they were teasing over the weekend, is that they would retaliate. As we talked yesterday, I think the Canadians have handled this very different than the Mexicans. Mexico has been very, I wouldn't say cooperative, but maybe deferential to the administration. Obviously, we've talked about why that is, but Canada has been somewhat defiant. And I don't, again, whether you agree or disagree with the administration, if you look at the playbook, defiance tends to get you on the wrong side of the administration. And I know this is geopolitics. I realize the Canadians are a democracy. Canada has a lot of pride. Canadians aren't going to like feeling like they're subservient to the United States. They never have. So I don't know if that's a shock to see it, but it's certainly going to impact the Canadian economy more than perhaps it impacts the United States.
And I might get some hate for this, and I've been thinking about it since yesterday, and I didn't say it yesterday, but it's still been kind of bumbling around in my head. I think this is sort of a really interesting example of how women negotiate differently than men as well.
Why is that?
Because Mexico has done, in my opinion, such a good job
Yep.
of understanding, not just necessarily playing hardball, but really understanding the impacts and thinking through the personal implications to the negotiation, rather than just I don't know the best way to say this. I think she's handled it incredibly well. I think.
But do you think, I get the whole worrying of the sexes, and if you go on X, there's a lot of stuff about that right now. But the interesting thing is, if you look at the EU, who's led by a woman, that's the counter example of.
This was just one example. I don't know that there's even a
So-
trend. That was just kind of my initial thought, that I think that in this specific case, they've both approached working with our administration very differently.
Of course they do. But I almost wonder if that's a Mexico-Canada thing. I mean,
Maybe.
look, it's an interesting conversation, something we will continue to track. But let's get into truck. Let's talk about used trucks. Obviously, used trucks are an important part of every balance sheet, but they're also an important part of our industry. And to talk about that, we have the president of Daimler Trucks Remarketing, Chris Backeberg. Chris, welcome to FreightWaves Today.
Yeah, thank you, Craig. Thank you, Julie, for having me. It's great to be here.
So lots going on in the industry. It does feel like we're in a recovery, and certainly across the Daimler business, you guys are having a much better year than maybe you've had in a couple of years. Tell us a little bit about the used truck market right now.
Yeah, the used truck market is really strong right now. And, if you look at information that Sandhills provides, the supply of sleeper inventory is now below where it was during the COVID period. So that's great for our carriers and for the leasing companies that buy our products and operate those trucks. They're able to turn out of them and sell them for a nice gain on sale. So pricing is very strong as a result.
So Chris, how much coordination is there with you and what you guys do in the remarketing side versus sort of the new order group at Daimler?
Yeah, we're very, very closely tied in with our new truck colleagues. In fact, I sit on, within our sales and marketing group, and we work very closely in new truck transactions and either work with them to, bid and try to acquire trade packages or set residuals, what will commit to buying those trucks back in the future.
So residuals have always been at least for the last 20 years, go back to the Jim Hebe days, and I don't know if I want to bring that up here, but going to anyways. Residuals have been sort of a polarizing concept. It's a really important thing for fleets, but how are you guys thinking about residuals so we don't end up in a repeat of 2001?
We manage our risk really closely. And so I would say we try not to overcommit, and we've got really strong models that tell us kind of where we need to be. Not all the time in a market like today, it's so strong that, our residuals won't get activated. But, in average or below average markets, they tend to do that. And we try to set those values at a level that doesn't hurt us like we did maybe 3 decades ago.
Did you guys see a situation a couple years ago where residuals were higher than the actual market value for trucks?
The past 6 years has been really interesting. COVID, everybody knows that story, and prior to COVID, inventory built. We as a company had several, almost tens of thousands of units in inventory, under 10,000. And then with the COVID, the surge in freight and the supply shortage, that depleted very quickly. It started to build up again in 23 and 24. Nowhere near as high as it did in 2020, but that sold through and cleared again really quickly. So I would say post-COVID, prices did come down quite a bit, triggered some residuals, and our inventory built, but it's cleared and it's low again.
It almost felt like you guys missed the entire COVID cycle, and maybe the supply chain shortages in 2002, 21 was sort of a saving grace because of the boom and bust cycle. Is that in many ways, I would get asked this often by people that are connected to Wall Street. They would see new truck orders, and we're sort of talking about the fact that it's a very strange thing that we're seeing still activity in the market in terms of orders, which were really delayed, but yet the freight market was suffering. So in many ways, you set this one out. Congratulations to the Daimler team for avoiding I think what the rest of the market saw in terms of the significant downturn. It seems like you guys really were well positioned for that.
Yeah, I'd say what I've seen happen over the past several years is that, when COVID hit, and then there was a surge in freight, and then there were supply chain challenges everywhere. We were not immune to that, and so from 2021 through 23, we had to deal with microprocessor shortages, and so whether it was Daimler or the entire industry, we all had to deal with those kind of supply chain issues that affected how we built. And so over the past 6 years, I would submit that the entire industry as a whole has not oversupplied our carrier customers. And so as a result, then, the sleeper and the day cab markets from a used perspective never became oversupplied. And then that enabled some stability in pricing. And so I think all of, maybe I would say the carriers are not oversupplied as far as tractors on hand to carry freight. We've not overbuilt. And so I'd say it's kind of a nice balance right now.
Yeah, that's good to hear. So first of all, I love seeing that you're coming from Fort Mill to be on the show today. I have great memories there. I went to grade school and middle school there. It is a different place now, for sure, than it was when I was there, but it's beautiful. I want to talk a little bit about what is driving the tightening of available supply of quality used trucks. Is it that we had such a long downturn that carriers held onto their trucks longer before trading in? What is driving sort of this current cycle you're seeing?
Yeah, I think there was a number of factors. So the people that had got into used trucks probably held on to them as long as possible. As you guys well documented, the carrier capacity, was a little slow to come out after the boom, and then it continued for several years as far as being higher in terms of carrier capacity that was available. So I think that was a factor. The fleets held on a little bit longer. And so I think, those are two primary factors, and, decent pricing from, the marketplace enabled them to probably turn out of them instead of having to maybe, liquidate them further down, the supply chain.
Do you anticipate, so right now we're talking about this being such an awesome market for you all, tightening supply of quality used trucks, certainly demand is rising. Do you anticipate more supply to become available in the used truck market? Are people upgrading and purchasing new tractors and then their fleets becoming available, or do you think this will be a little bit of a longer term situation?
The industry is definitely seeing, on the new truck side, definitely seeing a lot more orders or more come in that they have than the previous 18 months. So that's good. Does that translate into more used truck supply? That's a tough one. And so as long as used truck pricing is good, and I would say we're probably, from an OEM standpoint or a dealer standpoint, not going to see a huge amount of trucks being turned in. That's kind of how I predict that. And I would, say at least for the next 12 to 18 months, used truck supply could remain tight.
So Chris, Julie and I were just talking about the brake check week that's taking place across the industry, and maintenance being, a big piece, a big contributor to accidents and how important it is to maintain trucks. As the average year fleet ages, you do see more, the maintenance costs go up, things like that. How are you guys advising fleets? Like, what year, when do you start to see, if the trucks are older, what year do you start to see sort of maintenance costs really sort of exponentially go up versus what they are with a new truck?
Yeah, I would say around 4 to 5 years, call it 4.5 years, is where our carriers start to see those maintenance costs really start to cycle up. And think about it kind of maybe in terms of over the life of a truck, the reliability is kind of like a bathtub curve. And so it's actually kind of more tilted. So the front of the bathtub is a little bit lower, rear of the bathtub higher. And so as a truck gets built, there's some initial shakeout, and then the reliability, is stable, but starting to increase. And around 4.5 years and older, it starts to accelerate back up kind of the curve of the rear of the bathtub. And so, I would say our carriers know that very well, and they time the replacement right in that period. And for us taking in used trucks, we've got products to help, our customers that buy from us have confidence in the overall reliability of the trucks. We make our own warranties, and so we sell warranties on every used truck that we put in the marketplace, and then have extended warranties that could carry them for another 1, 2, and 3 years beyond that.
And that's the Select Trucks brand, essentially certified, if you're certified pre-owned, essentially for fleets. What is the warranty that if I buy, what is the 4 years, 5 years? Can I buy a 5-year-old truck and get the Select Trucks?
Yes.
Like, how does that work?
Yep, absolutely. So our first, the first customer who buys a new truck order, they typically put a 4 or 5 year warranty on it. By the time we take it, it's basically kind of expired. But then we will certify it, we'll inspect it, and we will put a 1-year warranty on it ourselves. And then there's an ability to extend that coverage into after treatment devices, or extend it into 2 and 3 year periods. And so, as a buyer, tell us what warranty you're interested in or what your concerns are, and we can structure the warranty and the warranty product to match your operating cycle.
I imagine that if I'm running a fleet, that's important to know that I'm not going to buy a lemon. I don't know if lemons new trucks or cars. I know that the lemon law has to do with change to new stuff, but you call a used vehicle a lemon too?
Yeah, yes, they can be. They apply that term to our industry, and we're subject to
Nobody wants to end up with those. So Chris, what is the market? So if we've been talking about trucks being older, I know the over-the-road long-haul market it's more challenging for older trucks because of the maintenance problems that you end up with. But where do you see really the demand for these 4 or 5-year-old trucks going?
Yeah, great question. I would, that's one thing that's changed over the decades. In fact, I'll just mention next year will be our 30th year of operation. I would say 3 decades ago, heavily owner-operator driven second and third life owners. Our customers today are almost flipped. I would say 3 decades ago, 80% owner-operators. Today, it's probably at least 60% small fleets. operating less than 50 trucks. And so what's kind of the visual of that customer? I think FedEx contractors. We do a lot of business with FedEx contractors, people freight forwarding. A lot of our trucks go into port operations as well. So that has changed a lot. We like to think that we like to put people in business. It looks a little bit different. And so whether it's a small fleet or an owner operator, both are important segments to us. It's just the past 10 years, I'd say it's shifted significantly into that small fleet type of operator.
And are you guys involved in your competitors or Daimler's competitors in terms of trucks? So if someone had a Mack Anthem or a Kenworth, they could turn that in as well, and you guys would take possession of it and liquidate it?
Yeah, certainly. Certainly we would, and we do. Our Daimler Trucks Remarketing primarily supports Freightliner and Western Star dealers. That's who we support. But we will quote and acquire any of those brands that you just mentioned and offer it to our dealer network.
Probably more for a fleet or that wants to do a conversion to Daimler. I'm sure that's more attractive for you guys.
Absolutely.
So you mentioned port operations earlier, and I read that day cab pricing is really strong right now. Do you think that is related? First, I'd like to hear more about that and why you think it is. And I'm wondering if it's related to drayage just having a moment, right? With intermodal continuing to pick up market share and imports remaining strong.
Yeah, and FreightWaves has been out in front of that story for many, many weeks now. And I would say we started the year wondering how we're going to get rid of 800 or so day cabs, and every single month it's gotten stronger and stronger. It's been really nice over the past 4 months, and absolutely we attribute to shift to intermodal and port activity.
You know what we need here at FreightWaves today, Julie? We need an RV, a retrofit, old Class 8 that you retrofit into an RV for a moving studio. That's what we need here.
Would be pretty cool.
It would be pretty cool. I'm all into that, Chris. If you guys, we could do America 250 theme. We'll go on a road show. We'll come visit you guys in Fort Mill.
That'd be awesome. In fact, we've got a motorhome truck division, so we can.
Oh man, we got to hear about this.
Yeah,
that would be pretty badass. Yeah, now, do I have to have a CDL to get? I think RVs are exempt from that, aren't they?
Yeah, they are. They are.
All right, I think Julie, you gonna drive one?
Nope. I will happily ride, but I have enough trouble parking my SUV.
Well, we're not gonna. That's probably best if we don't. Right. If you can't park the SUV, you probably can't park the RV.
Yeah, I downsized for that reason.
And how is retrofit a big piece of the business?
RV retrofit or
yeah.
Okay, yeah. So our division makes about 80% of the chassis for the motorhome business. We don't own the actual motorhome itself, but we sell to the people that put the motorhome on it. Yeah. And
these are like in Indiana, like the RV capital of the world or something, is in Indiana. Now that's a market that's been struggling, hasn't it? Like I see these things. I mean, we covered the boating market through one of our other divisions, and that's been a struggling market. I would imagine the RV stuff is also somewhat struggling just because of the post-COVID.
Yeah, is it struggling or is it just back to where it was when it had really kind of blew up during COVID?
I mean, Chris would know better than I, but at least the boating market sales are equivalent to, in some markets, down to the financial crisis. It's been, everybody bought a boat during COVID, and then everyone realized they don't need a boat. So RVs, I think, are sort of suffering some of the same dynamics.
I'm gonna defer that to a colleague of mine that runs that division, and he used to actually sit in this chair here in this office, and now he's running our school bus and RV business. And so, I think I've heard some of the same trends that you guys have, and I think the fuel prices and interest rates are probably an easy kind of headline to frame up what's going on. But I can't really comment on the day-to-day and have to maybe pull in my colleague TJ Reed on that.
Well, we're buying, so as a buyer, we're glad that the market's not strong because we can get our America 250 remote studio. Got to put a smoker in the back kind of thing.
Oh yeah.
Plug it in. We'll be good to go here at FreightWaves today. We should do that. I'm serious.
Put a Starlink on top. We're good to go.
Starlink. We will be all over. We'll be able to broadcast on the road. We go visit your factory over there. By the way, when I was a little boy, I think I was probably 8. My dad took me to my first Freightliner factory tour. I got to see the trucks assembled. That was pretty cool.
That's so.
It was much cooler than the Great Dane trailer factory tour for a little boy.
I would imagine, trucks are much more interesting being
Trucks are
assembled than
cooler.
trailers.
Nothing against trailers. I know we have some trailer
Very
fans
cool. Just
on the show.
not as cool to watch be assembled. Not as in.
And then honestly, the
much fun.
Gulfstream tour was top notch, but I don't know.
I imagine so.
You're always Chris. Good to see you. Appreciate coming in and joining us for FreightWaves today. Julie, we're going to do this. I think we should buy an RV. I think we should go a remote studio, and I think we should do a road show. And apparently, we can get a good deal on one right now.
I mean, I am game as long as I get home.
You're not driving
every couple days. Yeah,
I'll drive. It'll be good. All right, we'll be right back with FreightWaves today. We're going to get into sonar data, talk about the state of the market. There it is.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
The drivers, dispatchers, mechanics, and crews who keep the world moving deserve tools that work as hard as they do. That's what Samsara builds, technology for safer, more efficient operations, made with the people who do the work. Samsara, built with operators for operators. Learn more at samsara.com.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Welcome back to FreightWaves today. Julie, sonar, it's that, again, we talked about it earlier in the show. It's that time of year, or is the data telling us?
So really the data is telling us, so this I know you don't like it when we put all these charts together, but I started
I
here
do like
and then
it.
we
It's such the
zoom in a
power of
little
sonar.
and then we'll zoom in a little bit further.
And you can
So
see
this
at
is-
the bottom, just for those that don't know sonar, at the bottom is what we tell what we're actually doing. The only problem, if you don't know sonar and you're looking on a screen, the reason I don't like it on a screen is because it can overwhelm the audience with all this, charts. Obviously, as a power user, it's really, really powerful how many data points. And sonar enables you to take random data points
Yeah.
across the market and put them in here.
So I like to stack them up so you can really understand the trend and how they affect each other. So this is the truckload rejection index, and then I added in
So blue would be
truckload rejection index.
13.57.
That's right. And then I added a second dual axis to then track, so you could see them in line with each other. Accepted sonar truckload volume index, which is the yellow, and then the purple is the overall volume index. So generally, it's very normal for the purple and the yellow to move together, right? Especially if tender rejections are staying relatively stable, right? The same amount of freight is being accepted or rejected. Where we see the difference and this oddity is over here when tender rejections really spiked. And that was that really tight time we saw coming July, around July 4th. It's normalizing a bit. Tender rejections have normalized at that 13.5%, and we're continuing to see accepted volumes as well as overall volumes kind of stay and move together,
So in other words,
which sort of is normal.
Volumes are
These
stable.
Yep.
Tender rejections have stabilized. They dropped from where they were a couple of months ago, but down at 13.5%. It feels like this is probably a market low at 13.5% because we know as we head into September, October, November, rejection rates always firm up, even in soft markets. So it feels like that 13.5 is, and that's a great number, by the way.
I think it's a very healthy number. So when we talk to some of our broker customers for Sonar, they said that 8% used to feel like 8% tender rejections used to feel like, oh gosh, things are tight. And now they feel like it's more that 12 to 13% where things are tight and where they have a little bit more leverage with shippers in the market.
By the way,
tender
I
rejections
think a
move
lot
that
of the
low.
way I think about this is, we've talked about this before, is it's not about the actual rate itself. It's like asking, so it's right now middle of August or late August, we're getting 110-degree temperatures. It's asking what is a hot temperature. If I said it was 90 degrees today, you're like, that's not bad.
Oh,
Like,
it was 78 when I walked in this morning, and I'm like, this
it
is
felt cool.
glorious.
And so
like it's
all,
chilly.
It's
Yeah.
all relative to where you're at. So really think of it like the temperature. When we're at 13.5%, but we were a year ago down in the 6%, the fact we're at 13.5%, that's like talking about in the winter when it's, it's 40 degrees, 70 would feel really warm.
That's right.
80 would feel warm. Today, that would feel cool. And so it's the same thing. When we're talking 13.5%, we went through a couple months ago, that was sort of the peak at 17.5 of the cycle. It's cooled off. It's no different than thinking about the temperature.
That's right.
It's cooling off. We're headed into fall. Now, as we head into fall, as we head into the actual calendar of the fall, in September, we will expect, just like you do in the warmer months, you're going to expect that number to heat
Just
up.
like spring or fall, when one day you walk outside and it's really warm, and the next day it's really cold, and you have those 40-degree shifts,
it's all
right?
relative is the important
in
factor
those
here.
changes of seasonality is when we'll get some of that
So we're going to
volatility.
expect tender
But to
rejections to
me,
increase.
this right here, this is a very healthy freight market, in my opinion. You use that Goldilocks term.
I think
it's
so.
that. Now I think we'll head into more volatility
And
where
it
these
really,
charts will
I
line
think
up
when
so
you
nicely.
have
but-
stable tender rejections, it means that no one's getting caught off guard. Now, the brokers that like overflow spot freight, maybe some of the owner-operators would prefer a little bit more volatility, pressure. But when it comes to actual shippers, carriers are getting rate increases that they want. Shippers are not having freight left on the dock. It feels very orderly and feels like, things are a little boring.
This feels like a healthy market to really get your ducks in a row for what you want your spot contract mix to be. Whether you're a shipper, a broker, or a carrier, to have a minute to catch up and figure out, okay, this is what I want my spot contract mix to be, knowing there's going to be a little bit more volatility in the fourth quarter, and then my guess is back to sort of normal seasonality.
I said a freight floor. I didn't like this time. I didn't like stability. Now,
Well, it's just not exciting, but it's
not,
healthy.
You don't get the dopamine hits with the high rips and things like that. It's not as much fun. Now, if you run a trucking company, you love it. If you're a shipper and a routing guide, you love it. If you're a broker and you've got committed freight, you love it. Do you know who doesn't love it? Those high spot people that live and die by spot loads. A little boring.
We'll get to why I think it's not going to be boring. So this is, because I wanted it to not be too overwhelming, this is just accepted volumes and tendered volumes, right? So you can see these are accepted, these are tendered, and how they really kind of line up, and especially now are. And this is the truckload rejection index. So
it's
to your
much
point,
easier. That's why when we're on TV, it's why I always prefer to have
One
just
alone.
a single chart. 'Cause
Yep.
It's so confusing. But this is tender rejections. We saw it peak. It's above 17.5% against cycle peak. 'Cause
But
it's not
again, to
all-time
your
high.
earlier point,
Yeah, I mean, look, we were
in
6.5 a year
January,
ago.
yes.
And this was, if you think about it from a comp standpoint, it was really August, September, October was when the sort of first compliance crackdown started, the English proficiency started to take place, the non-domiciled CDL enforcement. We're almost to a year of when those enforcement actions started or really took force. It's going to be interesting to see how well the market responds on a comp basis, year-over-year basis. Really eager to see that as we head into
Me too.
October.
All right, so here's your dopamine hit, speaking towards potential volatility. So I wanted to look at what spot rates were doing, particularly with brake check, and if we were seeing anything yet in our data regarding that. This is just 1 month, so that's why it's got such big swings, and this is
You're
the
looking at
daily.
percentages. This is a
Yes.
percentage index. Inside of Sodar, you can change it from actual to percentage.
Correct.
This is looking at percent movement.
So
You had it
over the
back
course
in-
of a month, we're down 0.3%, right?
In early August, you had it as high. You saw some movement of 6%. End of the month does drive that.
Here's what I think is interesting, though.
The bottom.
Starting the 22nd through this morning, we're up 7%.
Yeah.
When you look at
it's
the
sort
daily.
of bouncing back to where
Yep. So I think we're heading back into that stabilized higher spot rates. People anticipating those fall surges, and I think we'll
Well, it's
likely
also
continue
headed
to
into
see spot
Labor
rates
Day.
continue
And we talked
to
about the
rise.
fact that Labor Day is later this year, and you have the last minute surge back to school, but people start resuming their business life. Like in Europe, they go on vacation all of August, and they don't really return until September. It's the same thing with a lot
true.
of parts of the freight market as people are, getting their kids back in school. Certain parts of the country don't actually go back to school until
We
this
didn't
week.
when I was
And
pregnant.
next week, and really after Labor Day, that's what's driving a lot of this activity. So as we head into September is when you should expect things to firm. And that's when that West Coast freight for imports,
Right.
moving for the holidays, shifting into the supply chains. We've talked about the fact that this particular holiday season is going to be earlier in terms of movement. Retailers are looking for those big pops in retail sales. They also don't want to hang out with a lot of inventory because of all the risks associated with that. So I think we're going to see an earlier peak season, not as big surges, but certainly more orderly.
Yeah, I agree. We'll keep watching this daily spot rate go up. But if spot rates continue to fall or tender rejections change and your routing guides break down, RXO is who you want to call for capacity now.
RXO is our sponsor, and they are here to take if your routing guides break and you're looking for that last minute capacity, particularly as we head into Labor Day, where that could definitely happen. RXO has the hotline; they're there, available. By the way, talking about South Carolina, Charlotte is where RXO's headquarters.
Fort Mill
are.
is a suburb of Fort Mill,
Really?
South Carolina is a
Yes.
suburb of Charlotte.
I mean,
So
it
yeah.
is. It's really interesting because Charlotte does punch above its weight in freight. It's got Freightwaves based there, RXO's based there. Our own Adam Wingfield lives there, but there's a lot of freight activity. We held an event there earlier this year. It was a really cool. I think Charlotte's an underappreciated city in terms.
Yeah, I
of
think
just
people
overall.
mostly associate it just with investment and banking.
Yeah.
But I think that has
It's
led
weird
to
that
some
it's a banking
logistics.
center.
Yeah.
Largely because of the Wachovia Bank of America transaction. But anyways, we'll be right back.
Provider of brokered transportation in North America, RXO has the scale, resources, and expertise to help you tackle any shipping challenge. From a last-minute spot load to a managed transportation solution, from LTL to intermodal, from trained logistics experts to AI-powered freight automations, RXO has you covered from the first mile to the last mile. Start shipping on easy mode with RXO and get a smart solution to move your freight. Learn more at rxo.com/capacity.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference, it's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts, 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. Julie, there's been some news over the last couple of weeks related, C.H. Robinson, this double broker, Montgomery, post-Montgomery, this nuclear lawsuit. But there's also been some of these double brokering lawsuits that have popped up. And look, I think ultimately plaintiffs' attorneys want to get back to whomever in the liability line they can get to.
Yeah, so this case is really interesting to me. So it's a case in Nevada. It's Hardy versus Singh. I assume I'm saying that right. So A1 brokerage, and ultimately the load was double brokered. So it was a truck hauling hay that was being driven by, Singh is the driver, right? That's why he's named in the case. He was the owner of GRK Transport. He skidded on a Nevada road in July 2022. They're being pulled into it from a case back in 2022. Smashed into a pickup truck headed the other way on a two-lane highway. One passenger in the pickup truck was killed and the other was injured. So what's the interesting thing to see how this litigation plays out, and I was able to pull some graphics from Inside Sonar. We have a risk management module where you can really get some good information on both brokers and carriers, past inspections, any past crashes, their operating authority, their DOT number, if they have a safety rating. All of those things are available, and you can see those in some of the graphics. But the freight was booked by A1 Brokerage, who then tendered the load to Lucky Transport, and then Lucky Transport in turn brokered it to GRK and Singh, who was the owner and the driver. However, Lucky Transport did not have a brokerage license. So it's a pretty interesting case.
So who do you think? So the plaintiff's attorney is going to try to go after
all of them, but
of them.
GRK and Lucky are both pretty small, and you can see in these numbers, which they're small for us to see on the feedback monitor, but GRK is one driver, two drivers. They do have some additional other issues that you can also see in the graphics that have come up, but they're going to have to pull as many people as they can in, because
Well,
with
I think that-
$750 million in liability insurance,
750,000.
$750,000 in liability insurance at a maximum, and I don't think the GRK even has an active.
Well, the issue is going to be that the plaintiff's attorneys now are going to look at every single chain of custody. Anyone who touched that load, we talked about shippers being liable, but here's the problem, and we talked about this before, is this whole shared liability problem in certain states where you can be 1%. The issue is if you are the wealthiest party there, the party that has money, even if you're 1%, you could be stuck paying the entire claim, which we talked about C.H. Robinson having this lawsuit in Texas. They're 23% responsible, and effectively they could be stuck with the entire payout because of shared liability. And look, the complexities of passing the load over, we've seen that trucking is a weird industry for people who aren't in it to understand how it works. And so when you're talking about double brokering, it does create a lot more questions in the minds of juries. And look, talking to plaintiffs' attorneys, the more complicated a story is, the more opportunities it is for a plaintiff's attorney to exploit these holes, these issues, and it's going to become a problem. So when we have double brokering, it goes back to, can I claim that this party did not take control of the load to the degree that they could have? And when you double broker it out and it's unknown, bigger problem.
Right, and clearly these other, I think Lucky is relatively small, GRK is incredibly small, and Sense actually is out of service with a controlled substance and possession violation, all of which, again, you can see inside Sonar. There's no money to go after with those two, right? So whoever else they can pull in is what's going to happen.
My worst nightmare as a broker would be to have a hay load that causes me to lose, because they're the worst kinds of loads.
Right.
It's like hay is just trash.
Right. At least to be like
You need hay.
something that you're getting paid well for that's worth
No, it's
something.
like hay's
but
nothing.
in hay,
and
yeah.
it ruins your trailers. It's got to be like the biggest nightmare of a broker and a carrier to be, probably the broker, to like, of all of the loads, to like lose your business.
Yeah, that really
Not
is
really good. It pays
not
dirt cheap.
ideal.
Sort of dirt, trash. All right, we're going to move it down to our next guest. He is Chattanooga native Rush Feldhacker. He's living in Tampa. He left us from Chattanooga. Rush, welcome to FreightWaves Today.
Yeah, hey, good afternoon. Thanks for having me.
UTC Mocs, it's football season. I don't know, you still follow the Mocs down there?
Oh yeah, gotta follow the Mocs. Have to dig for them deep on ESPN Plus, but yeah, we still follow the hometown team.
Time Free Press has great coverage of the Mocs if you ever need to pick it up. So as a shout out to my other side hustle. Well, welcome, Rush. Let's talk a little about Tabi. So you guys are in the price and RFP business. Tell us a little bit about really what Tabi is, what you're seeing right now in the market.
Yeah, so Tabi, we define ourselves as a rate management system. So we're mostly known for automating spot portal bidding for brokers on some of the larger shippers, but the product's grown a lot in recent years. So there is an RFP tool. We do have an email plugin to automate your email quoting. There's several tools on the platform, but what it allows people to do is actually capture all of their spot quoting activity, not just their wins, so they can make educated, disciplined decisions around their spot data instead of just shooting from the hip in their spot pricing behavior.
And you integrate data points, partnered with Sonar, which is amazing, with that guidance on spot rates too. And I will tell you that I ran a group of people who all they did was acquire freight via load boards, and having that data to see what you bid yesterday, what you won, what you didn't win when you bid yesterday. Your own history is in many cases one of the richest things you can use there, in addition to market rates and benchmarking. So I think that's a hugely important part of your tool.
Yeah, absolutely. And I was a long-time broker. I did it for about 16 years. And our pricing adjustments are just shooting from the hip everywhere. It didn't matter if it was a large broker or a small broker. But now our customers are actually really able to dial in where they have opportunity and be a lot more strategic in how they're acquiring that freight.
So what exactly are you guys seeing right now in the market in terms of how are brokers bidding on freight? What are you seeing in terms of market activity?
So we actually have an index, the Tabi Pricing Pressure Index, and the main part of that is a scale from 0 to 100, with 0 meaning that brokers and carriers have all the pricing power, and 100 meaning that shippers have all the pricing power. Right now, we're firmly at a 36, and this does take into consideration a lot of factors: volume, margin, awarded margin, bid margin, and so 36 is good. It is broker favorite territory. It is significantly up from where it would have been this time last year, but we've seen that come up 7 points over the last month. And talking to different brokerage leaders across the industry over the last month, what I'm hearing is that they're still winning spot volumes at a significant rate with good margins, but it's nowhere near what it was 3 months ago. And so I think we're seeing a little bit of normalization in the market out there, especially in spot, where people were just kind of throwing money at loads and winning whatever they wanted here around the time of that market shift earlier this year.
So, Rush, I want to make sure I understand what this index means. So, 0 to 100, if I am so put it in perspective from a carrier or buyer sell. So, if I have capacity, do I want the index higher or lower?
So if you have capacity, you want it lower. A 0 would be perfect for you. It means you're setting the rates, and there's nothing anybody can really do about it.
So I have all the pricing power if I have capacity at a 0. And if I'm a seller of capacity, I want it, or if I'm a buyer of capacity, I want it at 100, right?
Correct. That would mean you're very much setting the rates.
So it's very similar to the Sonar Pricing Power Index, but reversed. Like we're sitting at a inversed. We're sitting at a 70 right now.
Oh, it's like we could almost math
for the Pricing Power Index, which is same thing, right? Showing brokers and carriers have more leverage than shippers, but ours is also
it's an inverse.
Yes.
I mean, I guess, Rush, a lot of what you build and sort of the thinking is that this is really a floor broker product, something that they can use to really transact in the market on a daily basis. Is that the best way to think of it?
Exactly. It's just kind of understanding where the spot market is today. We have the benefit of having over 1.5 million spot loads flow through our system every month. So it's just an aggregate of that data. At what markups were those loads submitted at what markup were those quotes won at, and just kind of piecing all of that together. So it's free. You can find it on our website. But yeah, it's something that we release monthly, and it should give you a pretty good gauge of where the market was and where the market's going.
So did you leave UTC and enter the freight market and Access America? Was this your first job out of school?
Yeah, 2010. I was hired by Access America Transport. I knew nothing about what it was that we did to make money for the first 2 months that I worked there. And then I finally pulled somebody into a room and was like, do carriers pay us to find them loads, or how does this all work? And once it was explained to me, it kind of took off. So I was one of the early guys in that office. And I mean, what a lucky place to be in 2010.
Well, what a great lineage of all of the guys in that business. Young 30-somethings that were just killing it, slinging some freight. Ted Illing's got a great interview on Freight Caviar talking about how they were growing very similar to TQL. But I remember Access America being a Chattanooga native. In fact, having a lot of folks that used to work for me at Express Direct went to Access America, or part of the story of Access America here in Chattanooga. But what a great business. And look, I know those guys. A lot of them are my friends that were part of that business. And it's interesting because I don't think you guys knew what you were actually, not that you didn't know what you were doing. I don't think you knew what you were like a part of. You guys were just slinging some freight.
I had no idea. I thought that doubling in revenue every year was just something that business did. Like, this is what business in America looks like. So the first year I'm there, we did around 35, 40 million. The next year was 100. The next year was 250. The next year on pace for 500. And I'm just like, yeah, this is normal. Yeah, I'm 24 with like 25 people reporting to me. This happens in every business in America. So, once the Access days were over, you kind of got to like appreciate what you're actually a part of. I was so young at the time, I didn't really understand it. I just knew I loved my job and found, just a great place. And I think it set the value system that I have today about how I approach work and how I treat people. I couldn't have worked for better people than Ronald, Chad, and Ted, and still stay close with them to this day.
It was all like a culture. And what's interesting about it, I was talking, so Ted Ailing, I've known Ted for, 20 years now. And it was interesting because when I first started FreightWaves, he looked at me. This is just, and I don't mean to pick on Ted, but I'm going to since he's a friend. He said to me, he goes, do brokers care about the economy? And the reason I point that out was it just so much has changed about in those days, you just had to have great culture. And if you could hire people, there wasn't a lot of talk about the quote unquote freight market. It was mostly like, let's hire great people, let's put the right culture, the right incentives, and these people will run. There wasn't a lot of the consternations in the mid 2010s about how's the freight market. It just wasn't very transparent. A lot of people didn't even think FreightWaves was needed because there was no real conversation about what the freight market is. It's changed so much over the last 10 years.
Yeah, I completely agree. And I remember being on the floor one day and there was this shipment that I'd paid the same on every day for months. I think it was like $1,600 or $1,700. And then one day I came in and it was like $2,800. It's like, what is going on? So, you take a loss on it. You're taking a loss on all the loads that you have. And then you start realizing you need to quote higher. Then you start making more money. You're like, oh, this is great. And so life becomes good. Christmas presents get a little bigger. And then the market flips and everything changes. And that's when I started realizing like everybody around me was starting to pay attention to the economy. Like what's going on with the freight market? Why does this happen? And so, as we've gotten better data on the market in large part to your organization, I walk into brokerage floors today and I'll have conversations with people that have been there 6 months about, hey, when's the market going to flip? I mean, for the last 3 years, it was all anybody talked about, like when are we getting out of this trench? So yeah, I mean, it's a topic of conversation across brokerage floors everywhere in America today, and it wasn't that way in 2010. We just
hopefully less trial and error now than when we were starting out.
Because the freight market. If you were at US Express, and we talked about the freight economy constantly, but I think brokers were such a hyper growth industry that if you had a good culture. And you could hire people like Rush out of school, and you put them in there. You gave them incentives and said go, and you just took the freight bro culture, but that adrenaline of feeling like you were a part of something was really all it took in those days because there was so much market share being gained. And I don't mean to simplify it, but that's really this formula it's changed.
It's so different. I was in an office in Birmingham last week with a 26-year-old. He's inside of our product and is looking at data and analytics every day and then making changes to his pricing rules on enterprise customers based off of them and having conversations with me about how I forecast the next few months going so he knows what to do. It's just completely different than what we were doing. And I think it's really cool to have that depth of conversation with a 26-year-old. The talent in the industry now, they're so much further ahead than where we were at that age. And a lot of it is just the knowledge and the resources available to them. So yeah, I mean, that was a really cool conversation, but like I have conversations like that almost daily with these mid-20s guys. Yeah, it's awesome. I love
they're
it.
interested in the market. When I first started FreightWaves, the editor of the Wall Street Journal Logistics Report, Paul Page, is 2016, said to me, I'll never forget it, freight rates just aren't that volatile. Why would you guys need to exist? And I'm like, I was floored. This is, I have respect for Paul. He's been doing, writing about the industry for decades. But this was, I don't think people realized, unless you were in it, just how volatile the market was. Freight brokers were really, really sort of coming of age in the period in Rush in your career, 2010 to 2020 was really the sort of coming of age of freight broker. Maybe COVID was the eclipse of all that, or the climax of it in terms of momentum. But I mean, you were at Metaphora, you saw a lot of inside brokers. Who are the ones that are winning?
The ones that are winning right now are the ones that are extremely disciplined in their pricing approach. And that starts with understanding their data and analytics and then implementing a strategy that it's adopted organization-wide. So what we see with a lot of brokers that can't clear that first hurdle of understanding their data and analytics is they're still chasing volume like they should have several years ago. And when they're making adjustments, it's from the hip. They don't know what's going on. The ones that are winning are looking at their win rates on their large customers by lane. They're setting up capacity strategies based off of where the largest opportunity is. And they're not chasing freight that doesn't pencil out for them. They're only pursuing profitable freight, and they're being very strategic about it.
And how educated are shippers on the market? Because the other thing that I remember 10 years ago, even a couple years ago. So a lot of shippers were just not aware of the market dynamics or the state of freight. I feel like that's changed as well, where shippers are now much more in tune with sort of market conditions. You know, like if you talk to my dad 20 years ago, he'd say, we set the market conditions. We don't want, the driver shortage was part of the narrative of convincing shippers they're gonna run out of capacity because shippers were not aware of how the market is. That's changed as well, Rush.
Oh yeah, like completely. I mean, we've been in this capacity-led crunch for a while now, but shippers feel it a little bit later than brokers do, and a lot of that's because of contract rates. You know, the not so secret of contract rates are that the contracts aren't really enforceable, and the only reason that you honor them is to not lose your business. So brokers and carriers will hold out as long as possible to not give back loads or not reject tenders. So when the shippers start seeing those tender rejections, that y'all have made a really big deal and they're such a good data point, it's after whatever flip has happened. So I was VP of strategy at a brokerage out in Scottsdale until January of this year. But in early January, I was talking to a shipper and they're like, oh no, this is the new normal. It's never going to change. And, you know, I tried to tell them otherwise, but it's just that they haven't seen it yet. They haven't gotten the pushback from their providers. So they're starting to see it now, and they're starting to pay attention a little bit more now. But, you know, it's a 3 to 4 month delay before they start seeing enough rejections on a wide enough scale that it affects their business.
I agree. I think shippers, and then I think they started seeing it, but they didn't want to believe it for a little while as well, or hadn't been through it before, so they didn't really understand it.
I think that's it. I think I remember all of the sort of noise, we'll call it, on social media, the back and forth arguments between, you know, folks that were, hey, this is a permanent shift or a fundamental shift in the market, to, you know, a number of shippers and even brokers that were sort of like, hey, this is just weather. This is just winter weather. It's all going to pass. But a lot of it is recency bias. I mean, a lot of it is just the fact that, to your point, Rush, a lot of these shippers have never seen a carrier's market or where carriers have leverage.
And I think recency bias is such a good point, and that's why, and I used to always talk about that when I was doing pricing, that our operators had this massive recency bias on the last load they covered or what this week looks like. And when you're thinking about contract pricing or longer term pricing in those customer relationships, having data like this really helps put that recency bias into perspective.
Yep. So Rush, real quick, what do we see in the second half? How are you guys feeling about the second half? Are we going to have a strong peak? What are your expectations?
Well, on the shipper side, one point I want to make, and I think why it's hitting them so hard right now, is that you know, a demand-driven increase in pricing versus a capacity-driven increase in pricing looks very same on a rate chart, but it looks very different on their P&L. When times are good and things are booming for them, they can absorb this increase in cost a lot better than they can right now. Their volumes haven't increased at all, but their prices have, to no fault of their own. So that's why I think you're hearing a lot more from them than you have in the past.
That's a great point. It also explains why they don't believe it, because normally when they see rate inflation, their core business would also be increasing. They would see more orders and like, yes, of course rates are going up because my order flows up. But if they're not seeing the activity, the increase in demand, then it feels a little bit like disbelief. It feels like a lot of, to them, felt like noise. But again, that's why we have the data to talk through it.
Well, I think capacity-driven shifts catch brokers more off guard than demand as well. Why is that?
With the demand-driven ones, you kind of see it coming. You're kind of hearing the signals, and you're seeing more volume come to you. You're bidding on more things. The capacity-driven ones, I'm quoting about the same amount of freight as I've always quoted, but I'm like just making larger margins on there because you're at about the same percentage. So it just, you know, the demand-driven ones, you have a lot more opportunities to make money. You have a lot more trucks that you can book, and these capacity ones are just a little different because that volume's not there. There's the same amount of loads I'm covering. I just happen to be making more on them, if that makes sense. Or at least on the spot loads. On the contract loads, they're getting absolutely whipped.
All right, Rush, appreciate coming out. I do have one last question, really important. Greatest freight city in the country?
It's Chattanooga, Tennessee. It's not even close.
Boom.
Chicago tried to make a good run at it, and there's some very talented brokers there, but Chattanooga's number one. I will say, though, the Birmingham brokerages, while they're nowhere near Chattanooga or Chicago, very sophisticated, very good businesses. So
a lot of them in the steel business, right? A lot of those guys come out of the heavy. flatbed steel, which makes sense. I mean, Birmingham's a steel town.
Yeah. Thanks for having me on, guys.
Appreciate it, Rush. Go Mocs. We're
Go
fans
Mocs.
of the hometown team. We'll be right back with John Kingston.
At Saia, it's a yes isn't just an answer. It's how we're built, a way of working shaped by our people, our nationwide network, and over a century of know-how that keeps freight and business moving. From coast to coast and across borders, our full-service freight and logistics services turn yes into real solutions for real business challenges. Deadlines change, conditions shift. Saia is ready for it all. For every customer, every day, it's a yes.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. It is Tuesday. It is my second favorite day of the week. I like the trains a little bit better than I do oil, but there's a person to talk about oil who knows all about oil and the diesel crack spread is John Kingston.
But you like John just as much as
I
Bill.
love John.
Make him feel like a
John
love
is
child.
an institution. He's my favorite guest. You and Bill Stevens could arm wrestle over my favorite guest, but John, you're on mute, brother.
What?
John's on
I'm
mute.
on mute?
There we go.
Yeah,
Yeah.
you're off mute. Sorry, you may have not been on mute, but our control had you on mute.
Okay.
Welcome.
So, what do you want to talk about first? BMO or oil?
Let's talk oil. Let's go. Actually, John, let's talk a little bit about BMO. That's a good point.
Well, it's very emotional for me because I think today was the last time that I got to write this story. Not that this story is anything particularly amazing. It's pretty straightforward numbers. But, I'm going to boast a little bit and say I was the one that dug these numbers out 6-7 years ago. BMO is a huge lender to trucking, maybe the biggest. And when I somehow stumbled upon the fact that they release every quarter in their earnings figures on not just the size of the book, but also the size of the write-offs, the size of the provisions, the allowances. So this has been an incredibly transparent look into the credit state of lending and trucking, I don't think there's any really reason to believe that they would have a significantly different set of conditions than any other lender. If anything, you'd think that maybe they'd be better because they probably got a bigger database of information and metrics, that kind of thing. But they are presumably going to be sold. The transportation unit is going to be sold to Stonepeak. It's supposed to close in the fourth quarter. So this is probably going to be the last time that we have these numbers. There really just aren't anything else out there. And the one thing I would say it's shown the last few quarters is that, and Craig, you said this the last time, it takes a while for the credit metrics to strengthen, that the BMO numbers were not looking that much better last quarter or the quarter before, even though we know that the freight market was getting significantly better. This was the quarter when it did. And it didn't really show up in write-offs because, as I wrote, write-offs are really more of a backward-looking metric. But provisions and allowances and the size of the gross impaired loans, that's more forward-looking as the banks decide that they have to take steps to account for loans that they think might go bad or have gone bad. And those were shown to be, this quarter, they were down considerably. So clearly, this is the major lender, or one of the major lenders to trucking, finally seeing the stronger freight market conditions kick into their book.
So John, you have been following this data. This is the BMO big public bank. They publish truck credit quality write-off data that you've been tracking. Can we help you get, I mean, who says that Stonepeak won't agree to publish it? Like, are they?
Oh, I already talked to them. Forget it. Not happening.
Oh, they're like totally done. They're tired of you covering it.
Let me remember something. There's the P and PE stands for private. Okay, so that takes care of it. This was just a really, really unique situation. It's a publicly traded bank. They're very much out there as a lender to the trucking industry. As I mentioned, if you go to like the TCA meeting, because I went to the TCA meeting regularly. I also went to the ATA meeting a couple of times. When you walk into that exhibition hall, they usually paid for the front slot. They were the first exhibit you saw. I'll be honest with you, I don't know if other banks break it out. I think I'll probably have to look for it, but this was just such a unique situation that it's going to be very difficult to find somebody else.
Well, John, I'm sad for you and sad for our readers who enjoy reading the BMO report. We got to find, surely there's another lender. We had Mitsubishi Credit on yesterday. Maybe they'll step up.
Well, I mean, it's time to look. There's no doubt about it.
You need to send letters and ask the other lenders. If there's a lender listening, it's the time to come in with a new index to replace the BMO index.
Yeah, I mean, it's sort of interesting. As I mentioned, they were always, let's say, at the TCA meeting with the most expensive booth there, right in the front. Though notably last time they did not, but that's probably because they knew they were going to be sold. But you just wonder what the publicity value of that was versus getting your book written up every 3 months by FreightWaves. I would think that the latter probably has some pretty good marketing.
More valuable, and it's free. All you got to do is give John the data. John will talk about it. So if we have any financing firms out there that do truck financing that want to replace the BMO index that John is really sad about, rest in peace. John will be happy to cover it. So that's my shout out for them.
Yeah, or if they don't want to create their own index, we can help them do that too.
We can help them create that one. That's a good point. So let's talk a little bit about what the data says, John. You said that they are seeing finally some improving conditions, credit quality, less write-offs. Anything else that we can take from this?
No, I mean, they don't do any commentary, but I thought that the number that was kind of the most interesting, the biggest there was the gross impaired loans. I don't know the standards that they use for why a loan becomes gross impaired, but I mean, it was well over 500 million previously, and it's now down to about 440 million. So that took a big drop. The number of I've never fully been able to grasp, and I've tried to find out when a loan goes bad or when it's going bad, when does it become an allowance and when does it become a provision? An allowance hits the balance sheet, a provision hits the income statement. But why does one loan get one designation than the other? But provisions were not down that much, but allowances were down a significant amount. As I mentioned, the number of write-offs really dropped. It might as well effectively the same, down like $1 million. So clearly that's backward looking. So I think that the decline in some of these other metrics shows that forward looking, they see their book is getting much better. I still don't understand this sale. And there's a lot I don't know about it, but it seems to me that they sold at the bottom, because how this business, as of a few months ago when these metrics were all terrible, this had to be like one of the worst points since they bought this business from GE Capital back in 2015. Why did they sell it now? And when I spoke to Stone Peak, it was off the record, so I couldn't report it. They were a little reluctant to talk about it, but I got the sense that they thought they'd really bought at the right time.
Well, it strikes me, just following Trimble selling their transportation unit, we talked about, UPS sold what's now the RXO, the Coyote business. But I think these large public companies, John, don't like the cyclicality of trucking. The reality is we know the cycle really well, but investors, when you're in a much larger conglomerate of businesses, it's hard to get excited. And oftentimes it's a drag on your stock that even if you're selling at the low of the market, you're just kind of be happy to be done with it because we know the cycle. I think public investors in a BMO are much more interested in sort of the state of the economy, particularly the Canadian economy, and they may want to delever it so they don't have the cyclicality of their business.
Yeah, that could be because investors like a nice steady story, and you're not going to get into trucking. So,
we know nothing is predictable in freight.
I don't know if they're can put up that chart that I put every quarter, but that just shows like the last 4 quarters. What's staggering is to look at some of the provisions and allowances from, let's say, 2022 and 2023 and write-offs. They were doing write-offs. There was one quarter, I think they wrote off $1 million. $1 million, that's nothing, okay? And meanwhile, when in their worst quarter about a year ago, they wrote off $43 million. I wonder how many oil and gas I could see probably being that crazy too. But how many of their businesses does a bank have that would have that kind of volatility in the size of the number of loans going bad?
Well, I'm sure that's why BMO decided to exit it at, I wouldn't say at all costs, but, I was talking to, this is years ago when RXO purchased Coyote, UPS, they bought it effectively. I don't remember the exact number, but sold it without a lot of a sort of price appreciation in the asset, may even lost it. I don't remember the details, it's been a couple of years now. But I remember talking to Drew at the time they transacted on that, like, look, we're buying at the low of the market. It turned out it wasn't the low, but it was near the bottom. It's hard to time these things directionally. Yeah. We all know that. But really, the nice thing of buying at a market low, if you're private equity or you're a strategic, is you can get a hell of a deal.
Yeah, it's going to be interesting to see what they name this business as. They're not going to name it Stone Peak Lending, so they're going to have to give it a new name. And I don't know if they'll take the booth at TCA right in the front, but that's clearly been their mindset to really be out there. And I wonder if they'll have that freedom and the budget to market the same way once they're owned by Stone Peak.
I feel like John is really sad about those.
I do too.
Like he's sincerely, really sad.
I'm very sad. Because seriously, I'm kind of proud of the fact that I discovered these numbers, and really nobody else in the trucking media picked up on them except one. I won't even say who they picked up about a year and a half ago, and they write the story like about a week after us. So what's the point,
Yeah. Well, John, you have a storied career in so many ways. You're really known as our oil guy and diesel guy. You love to talk about the fact that the Brent contract was a part of your career and your storied career. But diesel, it's a volatile market. I've been watching these videos. You flagged it. I think so many people, because the broader U.S. media is focused on Hormuz, that everyone's sort of ignoring this Russia story. But we've been following all these drone attacks on Russian infrastructure, particularly refinery infrastructure. Look, the diesel crack spread is super high. What are your thoughts there?
Well, what's interesting is that the crack spread, like in the last couple of weeks, has actually kind of held. It's really, really elevated compared to what it normally is. But the AAA, the AAA, they put out an average daily gasoline price, and they put out an average daily diesel price. And in the last month, the average daily gasoline price has basically not moved, and the average daily diesel price has risen like 40 cents. This is so even though the spread between crude and diesel has stayed kind of the same, it had that big surge maybe, like in July. It's kind of held right now, but the difference between gasoline and diesel is enormous. Now, that's really just a point of reference to show you how strong diesel has been. It doesn't really matter in terms of anybody can do anything about it. But I think one thing that's getting overlooked, and believe me, I know this because I heat my house with heating oil, is it's August. Diesel and heating oil are structurally the same. They're not exactly the same, but they're very similar. And so you really haven't had the American public screaming about diesel prices because they don't consume diesel. Well, a lot of them consume heating oil, and you're going to start to hear about that too, because it suffers from the same conditions that have driven diesel prices up. So you throw that into the mix now, but that can kick back on diesel because if refiners have to take some of their distillate stream and start moving it more into heating oil because it's getting cold, then that's going to be a factor in diesel as well. So it's not
John,
a good situation for diesel consumers.
Its midterms are coming up in November. In Tennessee, we don't have to heat really until December. It's still warm down here. But in New Jersey, New York, it starts to get cold in October, mid-October.
Well,
Having to turn on the heaters.
And let me note that we have a swing state in Maine, a very important race, and they probably all heat with heating oil up there.
So it looks like this could be an election factor if what you're saying.
Yeah,
we don't see relief.
Gasoline has calmed down. As I said, in the last month, the price as measured by the AAA is basically going nowhere. But that may not hold. And I could imagine, again, you really have to look at this like swing districts, swing states. So there's been a lot of talk today about swing states in the Midwest that might get hit by the Canadian tariffs. Well, if you get a surge in heating oil, like a lot of these Maine residents, they probably haven't had to buy any for a while, or they bought some, but it hasn't been as big a big a bill as it normally would be. And suddenly they're going to be confronted this when they go to fill up their tanks in September, October, and now that does become a story, and it becomes a story in a swing state.
Yeah, and John, even though, and I think, as I understand the conversations as you've dove so deep into this, is a lot of the diesel pressure is the Ukraine-Russia war, not necessarily Hormuz. But I think the American public isn't that educated. They don't dive deep into, they don't nerd out like you do on sort of the state of diesel and the state of energy. They're going to point to the Iran war as the primary contributing factor when it comes to heating oil prices, regardless of whether that's the primary reason.
No, I think you're right. My favorite story about the educated electorate is that some pollster in New York was doing some work on New York City and Hamandami one, and he found that in Italian neighborhoods, he did pretty well because his name ends in a vowel. Some of them people thought he was Italian.
Well,
true story.
That's crazy. It's an unfortunate reality about the American public, but that's a different voting public.
Why isn't there more coverage on this, though? Like on actual, national, obviously we cover it, but
I don't think it's well understood. And
why do people just continue to allow Americans to think that
I think you have to go
diesel
deep.
is that this is all the Middle East, right? Because you think of all of the energy and all oil coming from there. But to your point, once it's refined, really Russia and Ukraine conflict has had a significantly more of an impact on it. Because people only care about gas, they don't care about diesel.
Well, yeah, it probably also is. It's a tougher story to sell because if you look at, let's say, import numbers of diesel, diesel import numbers, of course, the U.S. is a net exporter of diesel, but a big net export of diesel. But if you look at the import figures and you look for Russia, you wouldn't see them. Well, it doesn't matter. It's all one big market. So the loss of let's say Russian supplies into Europe or somewhere else, but primarily Europe, that'll kick back into the U.S. diesel market. But the fact that it's not a direct source, whereas people can understand, here's a big tanker of oil that came out of the Strait of Hormuz that didn't get here, that didn't come here. They can grasp that a little easier.
And I think they're also, the administration sort of told the American public this would be a one and done, very easy in and out type situation, very similar to Venezuela. And it's been anything but that. I think the war, something like 80% of Americans, I saw a survey this morning, are against the Iran war. The problem is, as we've talked about, it's hard to put the genie back in the bottle. We've sort of broken it. American military is great at that, by the way. We're good at breaking shit.
I think we transitioned into this without really talking about the real news here, today's news, which is that the DOE EIA price, which is the basis for most fuel surcharges, hit its post-war high today. It comes out weekly. It was released today. It's effective yesterday. But the number that came out which I think 564.3 or something like that, is the highest it's been since military action started. So that's kind of an important milestone. And in the story I wrote, I usually try to touch on a couple of issues in the market. There's a big sort of raging debate on social media. Axios wrote a story quoting some administration officials as saying, we've moved a lot out of the southern channel in the Strait of Hormuz, the one that's closer to Oman. And there are others who are saying they're citing data from places like Kepler and Varexa who track tankers, who are saying, no, we don't think so. Our data does not show that it's been that much. So this is a whole other issue that's been going on right now.
John, we're going to get to Tom Kloza, the founder of Opus, here after this. We've got an encore presentation of Tom with Gulf Oil. He talked about the drone attacks. Julie and I have been talking about drone attacks on refinery infrastructure. Really fascinating conversation that we had with Tom a couple weeks ago. We're going to show that. But John, how worried are you about drone attacks on U.S. refinery infrastructure?
Oh, but where would they come from? I mean, I guess you could have a sleeper cell in the U.S. that could launch an attack. I really haven't thought about it. I guess I have too much to digest and haven't been able to look at that.
Put that in your head.
Around the world, I mean,
I guarantee
it's a sleeper cell type situation.
Yeah, I guarantee the people who own the refineries have thought about it.
Well, look, I think in Dubai they built this scaffolding with at the airport. I don't know if you've seen this, the jet fuel tank.
I have, yeah.
Where they've covered it so that they won't. But it does strike me as a major risk. I mean, it feels like this is definitely a risk to the United States. To your point, they're not going to launch off the coast of, there's nowhere to launch them unless you bring them in. And we saw that with Operation Spiderweb in the Ukraine, where they brought a truck into Russia. And then all of a sudden, hundreds of drones went out and attacked airfields.
Yeah. So, well, tell Tom Kloza I said hello. I've known him a long time.
Well, you'll be able to follow that story. It's an encore presentation. We recorded it a few weeks ago, but it got a lot of views. We thought we'd bring it back. John, anything else we should be watching in the energy market?
In the energy market, boy, we covered a lot here. I mean, the one thing that's concerning is that it is August, which means that we're getting close to maintenance season, and that's when some refineries, not all of them, they'll take down a unit here or there for maintenance. And this is not the kind of thing that you really want to skip. I mean, they'd love to skip it in the sense that they're making so much money right now, in part because of that diesel crack spread. They would love to not do the maintenance. But if you don't, I mean, this maintenance project is not like sending a couple of guys out with wrenches. I mean, these are programs that might have been booked 2 or 3 years ago. They've got hundreds of contractors on site. It's not easy to defer them. And it's better off in the long run that you not defer them. But these refineries have been running hand over fist because there's so much money to be made. They're not going to be able to do that. Some of them are, but others are going to have to cut back because they've got scheduled maintenance. So that's a concern too, I say right now.
Last question, because I know you go to the ATA events. You're an institution and frequently there. Chris Spear is out of the ATA a couple of years earlier than his contract was set to mature. I've heard some things. Anything that you have in terms of insights there?
I will tell you, I have not heard anything except that he met with the board on Friday. It was his incentive or his initiative to say that he was leaving, and I guess he was asked to leave right away, which suggests I'm not sure what kind of rival you go to, but I guess he was in the office Thursday and everything was fine, and on Friday he was gone. So you probably know more than I do.
Well, John, appreciate it. We'll be right back. We're going to do an encore presentation of our interview with Tom Kloza. He is an energy expert, much like our own John. Kingston is going to tell us all about what the risks are in the energy market. Really some scary concepts or thoughts on these drone attacks. I'll get into that right after these messages.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference, it's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
So speaking of commodities, there's no more commodity that's tracked than oil. And the person to talk about oil and tell us the state of the energy market is Tom Kloza. Tom is the Chief Energy Advisor for Gulf Oil. Tom lives in New Jersey. He's joining us today from New Jersey. Tom, welcome to FreightWaves Today.
Hi, nice to be here.
Well, tell us a little bit about the state of oil as you see it. Obviously, you know, this has been a pretty eventful year, maybe one of the most eventful years. Although I know you do this, and every time there's a crisis, people talk about how unprecedented the crisis is, it feels like. What would you rank this crisis in terms of the impact to energy?
Well, it depends on what product. For crude oil, I mean, we've never seen anything like it. But right now, I would say the biggest focus in the place where the media really isn't focusing is on diesel prices. You know, we thought we'd never see prices as high as they were during the first few months of the Russian war against Ukraine, but we're seeing them now. And, you know, we saw Energy Department information released today, and it's pretty scary for diesel going through the rest of the year. I like to say, you know, I like to do a lot of presentations during the year. And, you know, the motivational speakers get the money. I get bupkis because I'm there to bring people down these days.
Well, you and John Kingston, our own energy reporter at FreightWaves, have been, you know, John talks about how, you know, he believes that particularly diesel prices, these refined product prices are going to go up, and he has made that case. Sounds like you're also in the camp of we're about to see a big surge in diesel. Is that the correct read?
Yeah, I think everybody focuses on gasoline because gasoline, you know, people react to it the way I react to the Dallas Cowboys. It just annoys the hell out of me when they win. And people see those prices and it annoys them, so it's got this tremendous visceral reaction. But diesel really powers the economy, and it's not just the on-road diesel, it's the marine diesel that the ships are using. And these prices are really, you know, bordering on insane. And were we to get a hurricane in the Gulf of Mexico, not even a hurricane that hits refineries, but just threatens them, we'll move the choke point from the Strait of Hormuz to the Red Sea to the Gulf of Mexico. And we could see really apocalyptic numbers for some of these fuels.
So let's talk about what does an apocalyptic number mean, Tom, and related to diesel. So, we're well above $5 a gallon, according to the EIA. Where are we going from here? Like, what could it be if we have a major hurricane that threatens the Gulf Coast?
Well, let's talk about it in terms of dollars per barrel. Everybody knows crude oil is, somewhere in the 80s right now. The price of diesel is about $180 a barrel on world markets, not with tax, not with any addition, but just the wholesale spot price for diesel. And it could certainly go above $200 a barrel if we had some sort of tropical disturbance in the Gulf of Mexico. And the United States is actually in great shape. This morning, you may have seen it, we exported almost 2 million barrels of diesel, distillate they call it, but it's mostly on-road diesel. We exported that much to the rest of the world last week, and that broke all the different records. And it means that in addition to, let's say, 3.5 million barrels a day of domestic consumption, we've got a market for almost 2 million barrels overseas. And the U.S. Gulf Coast, like it or not, is the cleanest dirty shirt in terms of places to find that product for the rest of the world.
Well, it's also, I've made this point before, is the Americas, and I use that term broadly, not just the United States, but the Americas is the only non-contested place that isn't in a conflict zone where you can get energy supplies. That strikes me as good for the economy. I mean, price and price risk, particularly for our audience of people in freight, is certainly an important conversation. But there's also the element of the demand side, which the United States is unusually in a place to provide some of the bumper capacity for the globe. Is that not good for the U.S. economy?
Oh, I think it's very good for the U.S. economy, and it's great for the trade balance. That does not mean that the Trump administration won't raise the specter of possible export curbs to temper prices. I mean, this administration has proven that, they can influence crude oil prices. Crude oil prices would probably be well north of $100 a barrel, but for all of the Trump interventions on Truth Social. I would not be surprised if they didn't raise the specter of possible export curbs just to try to cool some of the buying enthusiasm for diesel. It would be a horrible policy outcome, so I don't think they'd pursue it on that score. But don't be surprised to hear it mentioned on some of the platforms in the next few weeks.
It's always fun watching the noise on X, which is, on Friday nights, they love to go ramp up the attacks or at least the threats. And then by Sunday, right before the futures markets open, it's all, hey, we have a peace deal. And it is interesting watching it because there's so much market manipulation by the administration. As you point out, it's unusual. But the problem of doing a diesel ban, and look, it's not unprecedented, we've had it before, is that you effectively are going to drive prices to the floor for U.S. diesel that really doesn't help these refiners in terms of investing for capacity. What are your thoughts there?
Well, I mean, right now the world is short refining capacity. It's short probably 7, 8, or 9 million barrels a day. And one of the reasons it's short, and people don't realize this, is there's a genie that's been let out of the bottle in the last few years. And that genie is drone attacks on oil infrastructure, on some logistics, but mostly on refining. In the last week, we had drone attacks knock out refining in Russia. We had a knockout a refinery in Saudi Arabia. And I think a couple of days ago, there was a refinery in Libya. If that spreads, and even if it doesn't spread, it is a new game changer that really tightens the spigots for refined products output. The other thing you have to consider is, what you talked about, the Americas. The Americas are very, very dependent on U.S. diesel. Latin America, had much more refining capacity 10 or 20 years ago when Venezuela wasn't in, this decrepit state. And the United States is basically the supplier to Latin America, South America, and, to the rest of the world. So, the problem is if you need diesel to sort of justify your business or to run your business, you're going to be paying more for it for all of these reasons.
Tom, it is breathtaking to watch these drone attacks, not just refineries. I know that's a world that you care deeply about, but even these logistics warehouses in Russia where these things incinerate so quickly. I mean, it is absolutely, as a middle-aged dad, I spend my weekends watching YouTube videos of everyone. They say when you get to a certain age, Julie, as a dude, as a dad, you end up watching videos of war. Like you
Really?
pick your war. I'm very intrigued by this whole drone, Ukraine, Russia, and really, overseas. The interesting thing, though, is that at least documented cases, we don't know yet of any actual drone attacks on U.S. refineries. Is that inevitable going to happen?
Yeah. I tell you, that is something that keeps me up at night, not just in the U.S., but in Europe. And, Putin made some comments earlier about some of the drones that they've captured from Ukraine and using them, against European cities or whatever, which is pretty frightening. Think about it this way. I think it was, in the Civil War, they came up with the Gatling gun. That was a big game changer for warfare. The drones, you can buy drones or you can build drones for tens of thousands of dollars, and they could knock out billions of dollars of petroleum infrastructure. A refinery is essentially a powder keg. So you don't need much in the way of ordnance or payload to really knock them out. And we're seeing that across the world right now, but particularly on the other side of the world.
But Tom, what are these refineries doing? I mean, I've seen some of the United States military, the Department of Defense got $50 billion for a new agency that is doing drone, both building an offensive capability, but also defensive capability. Certainly the DoD doesn't move fast, except when it's sort of, when you have this sort of asymmetric warfare element here. But what are these companies doing? Are they doing it? Are they investing? Because it feels inevitable to me.
That's a good question. And I think there's a lot of investments in the construction of drones. You hear about Ukraine and how many drones they're making a month, and it's pretty impressive. As far as defending against them, that's something altogether different. Now, if you go to a baseball game and you see the netting that prevents people from getting hit by foul balls, they've actually tried things like that in Russia to protect some of the refineries, but as you can imagine, that doesn't do it. So I don't know what's going to happen.
It is interesting looking at
that. I have seen the videos of that.
The thing is, Ukraine's gotten so innovative, and it's interesting how this country that's in
innovation
is the mother or
necessity.
Thank you.
Gotcha.
Necessity
is the mother of all innovation, or something like that.
I didn't sleep last night. We had a major storm.
We had a bad storm last night.
Down in Tennessee, Tom.
But most of the innovation is offensive. Most of the innovation is offensive. As far as defensive, we hear a lot about Patriot missiles, but I don't know how you stop a $10,000 drone, particularly when there's 600 of them being lobbed against your facility.
I did see this weekend. Did you see this? Yeah, the swarms are interesting. But did you see this weekend? Donald Trump was in Bedminster, up near Tom, golfing, and they had a military. It was like I don't know what you call it, but it was there to protect drones. They actually put it right by him when he's golfing. Protect against drones. I guess it's probably a microwave thing that was protecting the president. But he's out golfing, and he's got this major, Humvee with these, looks like microwave things that they could shoot him down. And this is a story in
Let's just hope that
story in New Mexico.
Let's hope that the instruments that they use have greater precision than the way he keeps his golf store. So that would be.
We'll let you say that, Tom. But it's interesting because now you're having to, everything's changing.
Everything is changing.
And but I think it's interesting because it's asymmetric warfare. Taiwan is paying attention, but think of we've talked about this before, is that supply chains are, we're on the front lines. This is really where it's all taking place.
Yeah, but I think drone warfare will be with us for long after the Strait of Hormuz goes back to some sort of sense of normalcy. And that really has an impact for refined products and for, petroleum and petrochemical operations. And maybe the answer is something like the cone of silence from Get Smart, or maybe, something from Star Wars with laser defenses, but it's not out there yet. And that raises some pretty big concerns.
The issue, and they did this, I believe it was in New Mexico, where the U.S. Army was testing anti-drone microwaves, and there's a story. It's a lot of dispute in the aviation circles about whether this has actually happened, but there's a belief in certain narrative that an airplane crash, a U.S. civilian aircraft crashed because of one of these microwave tests that took place, because this plane effectively fell out of the sky. And so it was near a military base where this testing was taking place. And the problem with these microwave defense weapons is they're indiscriminate. I mean, their job is to protect the skies and everything, including aircraft. And so, I mean, Tom, it strikes me that this is a whole new world. As you said, you can't put the genie back in the bottle. It's irreversible, no different than bunker warfare and aircraft. And you look at every major military conflict, there's been some innovation that we've just been stuck with. I don't know if that's good, but that is the way it works.
Yeah, it's pretty frightening when you think about petroleum infrastructure and you think about how flammable it is all over the world. Is the electric grid as vulnerable? I don't know, but I do know that, for the first 48 years of my career, I never heard about a refinery being attacked with drones. And in the last 2 years, it's been happening in spades.
So, Tom, we talked a little bit about, the scary diesel situation and that prices, are likely to rise. But can you step back and tell us a little bit more about details about current diesel supply, and then how exposed is the U.S. to that diesel tightness with its own supply versus sort of the rest of the world? I think you mentioned that we're in pretty good shape compared to what we have available to export, but just sort of big picture overall diesel supply.
Well, the root of that is the capitalist system. And right now, if you manufacture diesel at the refinery, you're going to get $90 more for your diesel than you paid for the crude oil. So there's the incentive to make as much as you can. Problem is, the United States could make maybe 5.3 million barrels a day. And if domestic demand is pushing 4 and foreign demand is 1.5, you can really run into problems there. So they're certainly motivated. They can make a lot. The question is for how long, and what happens when refineries have to take pit stops and basically, do much needed maintenance on their assets.
Tom, I should. When I started FreightWaves, PRA world, Opus was always an inspiration. It's probably the first PRA I was ever exposed to was Opus. Largely because when we were buying fuel at US Express, we were using the Opus floating index, and we tried to do that for freight rates. Did you ever expect and see that PRAs would become as valuable as they are? Or was this an evolution of sorts, or going back to early in your career? You've got to be very proud of what you've built and the legacy that you've established.
Yeah, I mean, I have ambivalent feelings about it. I'm proud of what we started and that we brought price transparency to the markets. But, that price transparency has probably turned into a little bit of price translucence, where the numbers that get posted aren't necessarily the numbers at which commerce is taking place. So, that's a little bit of a disappointment. But in terms of the need for it, when we started Opus, we never thought we'd have clients who would spend millions of dollars a year for that data. But that's indeed what they spend these days.
Yeah, the valuations of PRAs, I'm sure, are somewhat shocking if you went back 30 years ago on how valuable these businesses have been for the work that they do.
Yeah, well, that's the interesting thing about the oil business, and I've been in it for many decades, is it is so much more profitable than it was years ago. And it's more profitable on oil production because of technology. It's way more profitable on refining. and it's much more profitable on the street. You know, the average gasoline margin in the last 5 years is about 40 cents a gallon, whereas it was 15 cents a gallon the first time we hit $100 barrel crude. So it makes sense that the PRAs and the people that are in the, you know, the margins and in between all of these different big players are making more money as well. I just wish it was me and not the PRAs.
You know, it is interesting, Tom, we like to watch the spread between retail diesel prices and wholesale rack prices. And the spreads, I mean, of course, there's been this massive consolidation of the truck stop chains. Now you have 3 major chains that are really, you know, in many ways price setting because they have such substantial market share. But the spreads, you know, I don't track the gasoline market, but we do track the diesel spreads, and just the amount of consolidation has enabled enormous amount of pricing power among the major fuel stops.
Yeah, you know, it's hard to fathom though. And one of the frustrations I had is that you look at the number and you see those big high prices posted by Love's or Pilot. And of course you recognize that an awful lot of the fleets are buying at cost plus, but are they buying at the real cost that, you know, the truck stops are paying? Or are they buying at a posted price, and there might be discounts of 20 or 30 cents in places like Denver? So it's become much more opaque despite all the PRAs and their best attempts.
I was told by an insider at one of the major truck stops that only like 2% of the fleets are actually buying true retail price, which is sort of an interesting misnomer in the fact that this is the price that fuel surcharges are set off. Is the DOE EIA price?
Yeah,
and so,
absolutely, it's crazy that the government fuel surcharges are tied to those numbers when so few. I mean, maybe a landscaper is paying those numbers, but certainly the big fleets are paying much better numbers. And the truck stops, and you've seen this proliferation of build outs of, you know, new enters and travel centers, you know, they're making out because they're buying at well under rack prices in these negotiated numbers.
Yeah, it is really interesting to watch. But the fact that it's, and what I was told by someone who knows this business, been around the fuel business for many decades, said it's flipped. In the last 5 years, it's really changed. Where, you know, you go back 5 years ago, there was a much larger proportion, particularly owner-operators, that were buying at retail prices. They might have got cost, or might have got retail minus. But now everything's shifted to cost plus, and that's been, or cost minus, depends on how big your fleet is. But that's just a complete change, total overhaul of how people buy it. And unfortunately, if you're paying a fuel surcharge, if you're a shipper, you're getting totally screwed by that.
Yeah, I mean, cost plus is very common, but the cost is something which is very equivocal these days. And, you know, the fleets are kind of the victims of that to a great extent. And certainly the consumers are, when you have these freight surcharges that are based on these numbers posted on high that really have no relevance.
I don't know many fleets that are complaining about the spread of diesel, just saying. Is they like that high diesel, that retail price, and big spread. That's how they make their money on these fuel surcharges. Tom, really appreciate it. Thanks for coming in and joining us for FreightWaves today. We'll have to have you back to get more updates on the diesel market, something to watch. Hopefully we don't have a drone attack to talk about.
Thanks for having me.
It's scary.
It really is scary.
Absolutely scary.